All right, the market continues to chug along with actually a pretty decent day today, but there are some signs popping up, some red flags. I'm going to show you what those are from a technical perspective. Not enough of red flags yet to alter the trend, and now the trend remains bullish. And I'm going to show you some of those signals that suggest how bullish we may actually be. So how do you reconcile those two things? So that's a main topic in today's video. Of course, big event coming up that can throw all that out the window, and that's the FOMC meeting at the end of the month. I have details later in the video for a special online webinar that we're doing at Market Scholars to talk about the FOMC and how the market reacts to it and what we expect to go from there. So make sure you stay tuned in the video for those details. And also we have a trade idea on a stock that's kind of fueling part of this in the sector. It's fueling this breakout, this bullish move, and we'll see if we can't take advantage. So let's go ahead and get started. Today is Wednesday, July the 24th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. Look at that jump up to extremely highs, 99th percentile for the near-term line. So quite the strong move. You can see the momentum line drop down a bit. We ended up with a slightly above average range, so actually a bigger range than what we saw yesterday. So nice little finish, a little flourish into the end of the day here with the S&P 500. The intermediate line still strongly bullish. So you have dark green shading, you have the rising green line, and you have rising market sentiment. Again, the three things you just about always look for in terms of like our bullish trend. So what's that? 3 days in a row now, bouncing off of this near-term low point that we developed, and new highs, at least on a high basis. Well, for that matter, on a closing basis too, because we closed here at 3014. So new all-time closing high on the S&P 500. Continuing to be bullish. You can see the Fibonacci, what would this be? The Fibonacci and cycles drawing tool, where you draw the Fibonacci lines, have the pullback. Right, here's our intermediate pullback here, and then okay, where's the next cycle going to be? And you can see kind of where some limits are. You've got what the 50% Fibonacci retracement there at about 3032. That area 3032. It's another 13 points higher. You got other areas of resistance above 3100, another one above 3200, and finally, all the way up to 3300. The reality is, on this intermediate run, we most likely won't get up to the 100% Fibonacci retracement. To get up to, to get up to 3032, which would be where the 50% was, also not really necessarily in the cards either. So this is a good intermediate run, and it's got a little bit of legs to it. It's not grinding too slowly. It's a little bit above average volume. Still looking pretty good. If you take a look at the Russell 2000, there's your big mover, right? Look at that nice big time bounce. Closing up above a bunch of levels. In fact, that's your best asset class, including mid-cap stocks, your best performing asset class by far. Really taking off to the upside. It had a bearish posture, not enough to change the trend, but it had a bearish posture. It's been underperforming, even with this rally, and really sharp gains. I mean, look at the S&P was up 0.5%. This was up 3 times that, more than 3 times that. So it's the near-term line still didn't get in the upper reversal zone for the small cap index. But you look at the the closing high here at 1575, and we got up to 1580. So we've closed, even if we didn't close above the high point of 1586, we did close above all these closes. So relatively bullish. Now whether that ends up being an extreme where okay, that's after lagging, we get one big push, and then blam, and that starts the bearish trend. Remember, the possibility of this intermediate pullback is out there. We've had a couple bearish, really strong bearish pullbacks, so that's out there. We're not extremely overbought here on the market, so I'm not suggesting that it's imminent, but the possibility is there. And if we end up getting a pattern similar to this, where we finally break out after sideways underperformance, we finally break out, and it turns out to be a evening star candlestick pattern and eventually that intermediate pullback that all the markets got, if that ends up being the case here, you can see how there's a precedent for that. So don't buy that breakout as okay. We're taking off, right? Small caps are taking off to 1750, and we're away from here. We've seen in the past that's been a little bit of a false indicator. If it is a false indicator, we'll find out by the end of the week, right? It only takes a couple of days to either hold that breakout or not. So we'll find out. And again, the posture is bullish. So if you had to say, well, what's it going to be? The posture is bullish. So you would say, you would guess, right? Because that's we're speculating, but you would guess that it would be a bull. We'd continue to move to the upside. Maybe not to such a big extent that 1750 here we come, but to the point where we continue to have an intermediate posture that's bullish here for another potentially month or two. Remember, we're already at more than a month into. In fact, we're going on 2 months. The intermediate posture started in early June the 10th. So August the 10th we'll hit the 2-month mark. So we're about a month and a half already into this bullish intermediate posture with this shaded dark green shading. For the first week, you didn't have the green line. For the next few weeks, you didn't have the market sentiment. So you can see over here, even though the line didn't turn green for a while, market sentiment was rising. So we could get another month out of this rally without breaking a sweat or working very hard to get it. And moving, if we finish right now, we'll hit 3032 and be done. Otherwise, moving up to 3100 is definitely within that month. You look at where this can move within the next month based on its options. 3117 by August expiration. That would be the 2-month move. That's within one standard deviation. So to get up to above 3100 definitely would not be a big move whatsoever. In fact, it would be within that one standard deviation channel move. Of course, you look at some of the other trend strength indicators. The S&P has been on gone this growing bullish trend on the weekly chart. On the daily chart, you can see it also maintains a strong bullish trend. So it's got a nice little move to this. It's not waffling in the least bit. The Russell 2000 is waffling. It's been very noisy, and we'll see if this breakout turns into a trend. It's had just a very, very weak bullish trend there, unable to really get going, and we'll see if that ends up turning into more of a bullish trend. And finally, again, you look at these Ichimoku clouds. You can see the Russell, as underperforming as it was, dropped below its blue line here and jumped up, right? So very bullish in that perspective. And then finally the S&P 500, you can see also continue, dropping below the green line in this case and bouncing back up above, more bullish, and it's got room to continue to be more bullish. Like I said, up to towards 3100. Keep an eye on whether this ends up being a fake out and a potential intermediate pullback, which would be a great thing actually. But otherwise, ride the trend that you see, and just expect it to continue to grind higher. As always, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red button that pops out, subscribe button. There's also one down below if you're watching this on, that's actually over here. If you're watching this on the YouTube watch page. Also, hit that thumbs up icon down below. That tells us, number one, you got something out of the video, you liked it. And number two, that you want us to do the video again tomorrow. So it's a quick way to give us feedback. We look at that every day. It's our way of getting feedback from you. It's our only way. So if you like these videos and you want to let us know, just hit that thumbs up. You can do that right now while you're watching it. Doing that day in and day out is a big deal to us. It kind of justifies the fact that we do these, that people out there appreciate them. So we appreciate those that do click those thumbs up. Again, comment also down, well, what did you get out of the video today? When people come to the first time to check it out, why should they watch it? They check the comments. So comment down there on why, what you got out of it and why people should watch it tonight. Join our Market Outlook email list. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our list. Follow me on Twitter for more content like this in between videos from day to day. And then join our Market Outlook community that we've created on Facebook. All right, if you're watching this video on our blog, again, just go to marketscholars.com. There's a link in our description, the YouTube description, that will take you there. Just go up to blog at the top of the page. You can find our Market Outlook blog up there. And then you'll see today's post at the top. But if you're watching this on the blog, we also invite you to subscribe to our channel. This red orange line, excuse me, up here at the top. Just click on subscribe. Again, you can do that for free. Very easy way to do that. In fact, for those who subscribe to our channel, we're gonna, at the end of the month on July 31st, we're gonna have a webinar, a special Market Outlook webinar that will only be for subscribers to our site, both our premium subscribers and our free subscribers. So we'll have a special kind of end of month webinar looking at the FOMC, what they decided to do, how the market responds. I'll be out that day on vacation, but where I'm going to be at, I'm going to be setting up shop and doing a webinar from there. So make sure that you subscribe to our site to be able to go to that webinar. If you click on the page, you'll find a link in there to be able to register for that. Again, that will be coming up July 31st at 8 p.m. Again, it will be recorded, so if you can't attend live, everybody who subscribes to our site will also have access to that recording the same exact way, just coming to the calendar here and clicking on the same link. All right, now let's get back to the charts and take a look at a long-term view of the S&P 500. And again, let me get rid of some of these drawings. I actually tweeted out, in fact, here, let me bring up that, well, we'll take a look at it in a second, this tweet that I put out there. You can see how we continue to be bullish. So we did get a higher line, and even though we got a small little lower shadow on this week's Hakinyashi, we're still, because we continue to point upwards, we're still up here. Now, keep in mind that if we finish as bearish at the end of the week as we've been bullish at the beginning of this week, then we'll end up with, this kind of small body with an upper and lower shadow on the Hakinyashi. Again, it won't be as big as these because the volatility is not as high, but something like this right here, or even like this, this is a little bit bigger too because volatility actually rose at the end of a bullish move, which is not normal. But more like this, you'll end up getting this kind of transition candle. That first week in October ended up turning into more of a bearish run. And I expect that we'll get this big of a bearish run, but I do expect that if we do get an intermediate pullback, and we pull back down to 2907, it won't necessarily break down, where the 38% Fibonacci retracement is. It won't necessarily break down. In fact, the level now would actually be a little bit higher if I were to move. Let's get rid of these. Remove that drawing and pull up the Fibonacci retracements here. Now that we have a new high, it would be just about, well, it's still about 2907, 2910 it looks like. Or 30, yeah, it's 2908 is where that 38% Fibonacci and where that support will be. Again, that's also, if you remember, that's where the volume support is, right around that level, that same area right here, both on the ETF as well, as the futures contract. Again, this level right below this low point and at this high point here is 2908. That's right where that point of control, that volume support is going to be. So if we do get that intermediate pullback, that's where we'll pull back down to, with the idea that it will just produce something like this, a red arrow, a drop below the moving average. Since we're at such strong bullish momentum anyway, it's hard to, we don't go from these high levels down to really low levels in one fell swoop. This was kind of very singular in the fact that it went from being that bullish to being that bearish that quickly. Part of it had to do with trade tweets and the FOMC rate hike, which the market just did not like, which is what they're trying to reverse now here at the end of the month. That's rare. It's more that we kind of grind our way from these such strong bullish levels. So part of the grinding is you end up with a pullback a little bit below the 50-day moving average. You get a red arrow and you bounce back up and then continue to trend, which is what I would expect towards the end of the year. If you take a look at the 3 green arrow charts, 3 green arrow, almost 3 green arrows. The MACD is almost green again. You can see from a 2-line perspective, it's still not above its moving average. Stochastic still not above its moving average, but rolling up. And again, don't expect another surge. We're not going to get another surge higher. it'll just be kind of grinds up and down, something like this. Now that we've had our surge, you can see how it's grinds higher now, and that's more of what we would expect to see going forward. We hit the 17-day moving average, we bounced off of it, and now we're above a rising 8-day moving average, and all three lines here are rising, and even though the moving averages themselves on these MACD and stochastics aren't rising, the MACD line itself is, and so is the stochastics now with that phantom green arrow down there. All right, now let's take a look at the intraday charts, and again, you see nice, good new 4-week high points. So we got a new 4-week high right at the end of the day, higher high, higher low, very little volume. Again, pullbacks, on any pullbacks, the 2907 would be way down here. But also remember too that this is going to start moving up, the 4-week low is going to start moving up really rapidly. So you got the Hakunashi open in this area, the last week's low point is in this area. By the end of the week, this dotted blue line is going to be up here too. So on any more short-term, on near-term pullbacks, this level of support it held initially here at the beginning of the week when things were kind of looking a little bit more bleak, like we might get that pullback sooner rather than later. That support held, and we've continued to push through areas of very little volume. Now on any pullback, that volume level that was here, which was the biggest volume area, now it's been superseded by this area right around 298. So that's going to be our short-term pullback. It could rise, but as of right now, that's going to be our level of support on any really short-term pullback. So you can see, breaking through the value area for the 4-week range, very bullish from a short-term perspective. One thing that's not very bullish, so really quickly, let's look at the range and the volume today. So we saw the range was just barely above average, 2.35 points. The volume also just a little bit below average at 46.5 million. So when you put those numbers in context, again, the ATR is right here, the volume's down here. These are very low levels. They've been lower, so these aren't extreme lows. These aren't crazy lows. And you can see when you're below 1% when the ATR itself, when you're at average ATR and the ATR itself is below 1%, then we're bullish, right? We're in a nice, good bullish trend, and volatility reflects that as well. Volatility is also not extremely low, but it is as low as it's been. On a relative basis. On an absolute basis, it's closed below 12, and if you look back, we haven't had a close below 12, and we got over here the 1209, but since we had the run up in October, we haven't had a close below 12. So this is the first time that we've closed a day below that. And so you can see that on an average basis, relative basis, it's also the lowest point we've closed there too. It's not extreme, but we are entrenched in this bullish trend, and that entrenchment is just volatility is so low, we expect it to grind. Now, one thing to keep in mind, volatility got really low really fast, kind of abnormal. When you get a little bump, you tend to have relatively big ranges, 8-point ranges. In fact, if you take a look at the ATR for volatility here, where are we at? ATR, there we go. The average range for a month is 8.5 points. So you get a big surge, you start to pull back, 8.5 points, ranges. These are normal. Then you got to a point where you get too low, 4.5 points, and we have a bounce up. And over here, you dropped really quickly again, 4.5 points, 6 points, and then 3.33 points in terms of volatility range. And then we had a little bit of a jump up to 23. Well, now look at this month's volatility is even less than 3 points. That is insanely low in terms of how low the volatility of volatility is. So that's a little bit of a slight indication that we might, we instead of hitting that 31, we might hit the 2907 before we hit the 3100. That volatility is. We're a little bit too complacent too fast without having normal levels of volatility, which doesn't necessarily mean we have to spike up towards 20. But to have 8-point ranges after a surge is not, you can see that the range on that month in May of last year You know, the range, the high hit 18, under 20, but the low hit below 11. The next month, the low was at 11 and a quarter, and the high was at 19 and a half. The month after that, the high was 18 and the low was 11 and a half. So you can have ranges of volatility between those levels and be normal. To get this small on range that fast, that's a little too complaining. We're not extremely low. See, that's the difference. You know, in some of these other areas, we got extremely low, you know, back in, here would that be September of 18 and then April of 19. When you look at these levels here, September of 18, you know, you can see we were also we were trading at the lower end of the bullish range. And you go to April of 19, we were flirting with the lower end. So we're more looking like the low, you know, we're more looking like April of 19 than we are September, where we pretty much ended the market sentiment run. Here, you know, in April, we ended the intermediate run. And if we end up getting a little bit of a pullback, that's probably more of what we get, more so than the beginning of a market sentiment, a longer term pullback. So to summarize, the market posture is still strongly bullish. The trend is there. The market forecast shows bullish trends. We're not overextended in the least bit in terms of timing, so we can continue to grind higher. But signs of a pullback, of a possibility in a pullback, of an intermediate pullback, are also cropping up. That doesn't mean necessarily bail on any bullish trades. It just means that we start to lower the risk, right? We're not coming up off an intermediate low point anymore. We're a month and a half off of it. So, you know, whereas before when we were first starting to come up, you can be a little bit more aggressive and, you know, with directional trades. Now you start to reduce your risk. You start getting less bullish in your active trading and start balancing out a little bit. You can still have a bullish bias because that's what the trend is and the posture is. But because of the risk factors that are starting to creep up, we start dialing back the risk, right? If we lost on all of our trades all at one time, how much would we lose, right? Well, that whatever that number is, if we got stopped out on all of our trades, whatever that number is, should be starting to get smaller and smaller as we continue to grind higher. So that if and when we do get a jump, because it will come out of nowhere. You see how the volatility jumps up out of nowhere. It'll come fast, and it will be too late before you can recognize it. If that does happen, then you don't get hit so hard because you've been gradually reducing as you've been grinding. For example, in this area, that if we continue to do that right now. So, what do you think? Do you agree with that assessment? Do you disagree? Click that link right there is popping out in the top right corner of your screen. Hit that poll. Hit either agree or disagree. If you click disagree, comment down below on what you're seeing that would suggest otherwise from what we're talking about here today. All right, if you take a look at what's driving price action today from an intermarket standpoint, we had a little bit of a change here, which is kind of interesting to see. If you look, the small caps and crude oil have kind of been lagging together on this little bounce, but today that broke. Everything else flat as a pancake. The U.S. stocks are up, outpacing. You can see the dollar was flat. Gold was up today. Dividend stocks and value stocks were up. So this wasn't like pure risk on, right? You know that gold value outperforming growth, which is down here, and dividend stocks outperforming like preferred stock. I mean, or any other large cap stocks. That's not necessarily the most risk on trade. And gold being up there, you can see long-term bonds are up there too. It's a little bit of a risk-off pattern. You can see diamonds down here at the bottom, as well as commodities really getting hit the worst, and long and short-term bonds underperforming their long-term counterparts. So, you know, not the most risk-on, but the fact that small caps broke out and broke away from what crude oil has been doing, and they've been kind of linked in their underperformance compared to U.S. stocks, that's a little bit of an interesting chart development. You know, whether that turns out to be more than a one-day phenomenon, that's what we watch for, right? Because that small cap breakout we've seen before cannot hold. We've had a big breakout on small caps when it diverged from the trade of the day, and then it just dropped and pulled back down and within a couple of days. So we'll see if that ends up being the case, or what we'll see is that crude oil, the move on crude oil that we're seeing today, this drop will also just be temporary, and we'll bounce off this low point and head higher. Where we're getting, some red arrows right now on crude. You can see you got another set of 3 red arrows here. That will be temporary. So something's going to give there. Again, if the posture remains bullish as it is, then you'd expect crude oil to give and it to bounce up. But we've seen in the past where small caps gave. So we can't dismiss that. We can't expect it because that's a counter trend. But we can't dismiss it either. So we'll keep our eyes on how that rally. I did want to point out how bearish yields are, how bullish bonds are, and how that reflects compared to the past. So you can see over the last 20 years, there's only been 9 times that the PPO, which is the gap between the 50 and 200-day moving averages, that we use the 10-week and the 40-week. So the gap as a function of the 200-day move, the size of the gap as a function of the 200-day moving average, the percentage of that. So this is apples app. This isn't this is the gap, the size of the gap divided by the value of the 200-day moving average. It hasn't been. It doesn't get this low very often. Bonds are not this bullish. This is yield. So bonds are not this bullish this often. And when has that been the case in the past? You can see here on Twitter. If you follow me on Twitter, I shared this chart here. Here is the current time right now. And again, I've got, let's see, 2 charts here. I've got the chart for the 10-year yield here as well. And then the S&P. I forgot to put on this one, the one that's right here. I didn't, so that's where the new chart here is updated. So there's the 5th one. And then there's where we're at now. This is the last time that bonds have been this bullish. There's a time where the bonds have been this bullish, and a couple other previous times. Here's the credit downgrade of 2011. That is one time where bonds have been more bullish than we are now. The other time is right here. So these are 2, bonds are pretty darn bullish right now, considering that the last 2 times they were more bullish were in like dire circumstances. U.S. credit was downgraded. We were at the worst part of the Great Recession. But in all these other times, again, barring this point right here, which we were already in a death cross environment when that occurred, all the other times have been pretty bullish for stocks when bonds have been this extremely bullish themselves. So, that's a function. And again, if you're not following Ken's classes on TD Ameritrade's education site are some of my favorites that I like to watch. If you're not following him, he's a good follow at krose_TDA. But he kind of mentioned here how we have a little bit of a rotation out of these safe havens into more cyclical areas. Well, that rotation, this is the sector rotation that as of the last 200 days, there's still room for that to go. There's still room for these interest rate sensitive, considering how bearish these yields are. There's room for these to come down and energy materials to come up. And as well as the other cyclical areas that come up too. So that will mean the markets are bullish, and if these materials and energy rally, it will also mean that the dollar is bearish, and you'll see financials outperform too with rising yields in that environment. It's the yield, especially if the yield spread itself rises. Here's the dollar index. Here, let's go to a daily chart on the dollar index. It had a kind of a bullish breakout yesterday. We'll see if this ends up pulling. Remember, 98's the level. This level right here, getting above 98 and holding, we haven't been able to get above 98 and hold. Every time we've gotten to 98, we break down. So we've gotten up there again. Surprisingly, we've gotten up there again, but we're still in a very noisy period for the dollar. There still is no trend yet. See how noisy we've been all year long on the weekly chart? That still is the case, and on the daily chart you can see it here too. Still very noisy. We're still not getting a trend. We need to break out to hold a trend, and that will kind of nullify. Materials and energy would underperform, and you'll see, you'll still see stocks can still go up, and they'll be led higher by technology, communication services, discretionary. those will outperform more than these dollar sensitive areas like materials, industrials, and energy will. They can still be bullish, they'll just lag. That's if this dollar bullish trend takes hold. And like I said, has not been able to all year long. It's just been very noisy. It's been elevated, but it's been very noisy at these elevated levels and unable to break out and get going. And the longer it stays noisy at these elevated levels without breaking out to the upside, the more likely, and the range tightens up, the more likely we are to instead break down to the downside. And as Ken mentioned, you can see the rotation over the last couple of weeks. Utilities and real estate lagging behind, along with healthcare, which can also act as a safe haven area. It had its own issues, right, too, but it can also, the communication services has a utility, interest rate sensitive element to it, in addition to the Netflix of the world and the Facebooks of the world and Googles that are in there. But look at what's leading. You got materials, you have industrials, energy had been lagging. It's starting to pick up. It's really kind of picked up off these Thursday low points. And then you got technology with earnings is really kind of driving the action right now. That's why we continue to be bullish, and that's good. That's the kind of the rotation you like to see if we're going to continue to be bullish. Today, financials took hold, which is a good sign for that sector, which has been such a big laggard over the last long and so many months. All right, one stock that we have in one of those bullish sectors is Seagate Technology. A little bit of a breakout today. In fact, kind of, before today, right here, sitting right at the volume node, and then boom, breaking out above all this volume and starting to get into areas where there's very little volume up above to hold it down, especially as more of these days come off and we start losing volume up here and the value area itself shifts down. So good strong breakout above the Bollinger Band. If you look at some of these other trending indicators for STX, you can see good bullish pattern, dark green shading, dark green line, rising market sentiment, even if it is lighter. From a 3 green arrow standpoint, you can see that we have 3 green arrows today with a little average volume. Again, low volume environment as it is. You look at its Ichimoku cloud that you have here. You can see up above the cloud breaking back up above its green line after having crossed down below it. You look at its trending indicator, the trend strength indicators here. No trend on the weekly chart yet, ramping up, but strong strengthening trend on the daily chart. So a good bullish close here on the daily chart. You can see we saw the Bollinger Bands already. If you take a look at the STX getting above 25, getting below 20, that's a good breakout pattern you like to see there. So a good move all around from this a long-term view on this chart. You can see that we kind of have been so sideways we're getting a bullish crossover, but it hasn't really broken out. It's kind of setting up actually for a little bit of a breakout one way or the other, and considering that we are currently in a bullish trend, we'd expect a little bit of a breakout to the upside until we see otherwise. You do have earnings coming up. That's something to factor in. So in that case, I'm going to look at buying this at the money contract that's out here 23 days out. Not very far. It's right after the earnings. So you got 23 days out. You buy this contract. You can see over the next 20 some odd days, current volatility suggests that this could go up to $54 a share. $54 a share. Let me just show you where that's at here for STX. That puts us up, into this area. So it'll be a little bit of a breakout right up to that volume node right there. So, we're going to set up a trade where we only need to get above 52. Which is right here, and then stay above 52. So, it's a directional trade. Gives us a small loss. We buy at 49, we sell at 52. If you look at what that looks like here, we have $122 loss. We'll you position size depending upon what your normal position sizing is. You want to cut, make it smaller than normal because of the risk, and ideally you don't want to take the full $122 loss. You would like to cut it in half at about $60, and then your maximum gain is at 180. So you get in about a 3-to-1 reward to risk ratio in a short amount of time if the stock breaks out and continues to move higher, fueled higher by this earnings announcement. And if it doesn't go up higher, if that earnings makes it go down to the downside, then we'll lose $60. Very forgiving trade here. It's it's that, see, the line steepens here to the downside, but then it's starting to flatten out more. So it's more forgiving in this area, allows us to have more of a bigger move and still not get down to a full $122 loss after that move. So, and allows us to be able to trade an event coming up with a directional trade without having too much at risk. Well, all right, well, that does us for today. As always, thank you very much for coming on. I appreciate you watching. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment on the video below. Remember to subscribe to our website to get access to our Market Outlook webinar that we have coming up at the end of the month on July 31st. For free, you can subscribe for free. That button's at the top of our webpage, website, marketscholars.com. Also, remember to follow us on Twitter for more content in addition to these videos, as well as join our community that we have on Facebook. As always, thanks again. Have a great rest of your day, everybody, and we'll see you all next time.